If you just kept your repayments at the 7.5% level in terms of what comes out of your bank account, when they're down to like 4.7% where they are now, you go from paying $1.2 million in interest to $500,000 in interest. So you're $700,000 better off. We are back in your life, and today we are answering your questions. Michael and... What? Makayla and James.
Makayla and James, dynamic duo.
Literally, Mike has not even left to go to Europe yet, and somebody else's. This was bad. Don't tell Mike. So, Makayla, this morning, I ran a webinar with Auckland Council, and it was all about building wealth. And these guys and gals asked so many questions. I was like, stop talking, stop asking questions. This is all great, but we're going to do a bonus podcast edition because there were so many. If you do want us to come into your workplace and run a webinar at no cost, just pop something in the comments or Google Lighthouse Financial, look in the show notes, and we'll come out and talk to you. But Makayla, we got questions.
Okay, so we have a massive overflow of questions, and I'm going to Q&A James on these. So
you get in there too. You know, don't make it
I'll
all
answer some.
Yeah.
Okay, James, let's kick things off with the big one, investing. People want to know where to start, how they can do it, and how to have their wealth journey.
We want more money and we want it now.
More money. So first question, when is a good time to sell shares?
Yeah, I saw this question and I did think it's a bit of a peculiar question because you sell shares when you need money. So the first tip I would give is never, ever, Makayla, promise me, to buy direct companies. You do not know what you are doing. Yes, you might have your Sharesies account. You might be doing some great things on there, but just invest into funds. You have no right to be buying direct companies just because I assume the people that are listening to this, they're trying to get ahead, learn about money, but it's not like they're looking at the company's profit and loss and studying the shareholder notes and all those kind of things. So just pick diversified funds. When you pick diversified funds, a bad time to sell shares is when they're down because you're crystallizing losses, but you sell shares when you need money. Don't try and time the market, which is what I'm worried that question is asking.
James's motto. All right, next one. When is a good time to start investing?
Yesterday? They say, what's Warren Buffett's quote? The best time to plant a tree was 20 years ago. The second best time is today. Either way, eventually you'll be in the shade.
Do you think people should still be investing if they have a lot of short-term debt?
I think if you can day trade your way out of credit card debt for sure. You just need our patent pending. No, I'm joking. If you've got short-term debts, obviously focus on paying off those debts. Because if you think about it, a credit card might have like a 20% interest rate. And so that's 20%, no tax, no fees, no inflation, right? If you had to invest your way and outperform that, it'd be like 30% plus, more than 30% return year on year, which would mean you'd have to do like 300% the stock market each year. So that's pretty unlikely.
Are you saying one specific company isn't going to get me that return?
No.
Okay,
well, if we build a time machine and then, like Marty McFly, like he bet on a sports game and then like made all this, if we can do that, then that'll work. Otherwise, just pay off your credit card.
So the black and white answer with no Marty McFly involved is...
But have you seen Back to the Future?
I have a long time ago.
So the black and white answer is that you focus on paying off your short-term debts first, then you focus on paying off your mortgage next, and then once you are mortgage-free or if you are saving for the longer term, then that's a great time. But the other mistake I'm sure you can relate to, Makayla, is do not invest into the share market if you want to buy your first home soon.
Yes.
Because if you go to pull that deposit out...
Yeah. Market crashes, deposit, down the toilet.
I think one of Mike's clients had to go to their parents and be like, hey, I have to sell my house, my shares, my crypto's dropped. Can you please get me some money?
Not the crypto.
Yeah, can you give me some money so I can settle on my first home?
It's rough. Okay, next one in the investment category. This one's actually quite specific. So are dividend-paying U.S. shares more desirable than New Zealand or Australian ones, given the exchange rate risks?
You just I think people just overcomplicate. People probably do this like with their mortgages as
Mm.
well, right? They just try and go like, should I pay off my mortgage weekly instead of monthly because I'll save interest costs? Like that question is pretty much asking around FX and going, is that a good idea? It's a horrible idea unless you really know what you're doing. It's like flipping houses, great way to lose money. Just invest into a diversified share property bond portfolio that aligns with your time frame and risk profile. Don't overcook it.
Because there are funds we have in New Zealand that have shares within US portfolios as well, right?
Yep, for sure. And there's you can invest into US share funds that focus on dividend stocks as well. So dividend style investing is really going. There's two ways to make money. Either the value of the share goes up, or it pays your regular income. Same as a property, right? Value of the house goes up, or you get paid rent. Hopefully, you get paid rent. But that dividend stock approach is going, I'm really focused on the cash flow side. It's the Ilsa Wolf of share investing. So it makes a lot of sense, but I would just not overcomplicate it.
All right, next up is the Kiwi favorite, property and mortgages. So I feel like I might be able to answer some of these questions, but I'm going to pose them to you anyways. And if you don't know, maybe I'll jump in. So first one, should I pay off my mortgage on the investment properties first or use that money as a deposit for an owner-occupied home?
It's a good question. What do you think?
We always tend to say go towards the owner-occupied home first. So pay down that debt first, focus your cash towards that, because generally with the investment properties, that's a long-term hold, right? So you expect the value to go up, which means, maybe in a few years, if you want to sell it, it will pay itself off potentially, but focus on the owner-occupied first.
Yeah, and the investment property mortgage is tax deductible as well, right?
Yes.
So the debt on your own home is not, so you should focus on paying that off. And then once you've knocked that off, you can look at other debts.
Yeah. What's the difference between paying an extra $100 on your mortgage versus reducing from a 30-year to a 25-year term?
So for context, in the webinar that we did, we have slides where we go, if you pay an extra $100 a week on your mortgage, $100 a week, $100 a fortnight, $100 a week on your mortgage, you pay off your mortgage 6 years faster if it was an $800,000 mortgage. So I think this question is going, well, what if you do that or you just shorten the loan term? What do you think?
So I would say about this, when it comes to your mortgage term, most banks have an amount of extra repayments you can make annually without incurring any penalties. And we wouldn't necessarily advise people to reduce the actual term of the mortgage, because then what happens is if you run into a situation where you've had a family emergency or you've lost your job and your income has dropped, you won't have the option to put your payments back to the minimum. So if you're on a 30-year term, but you want to make extra payments, we would just say make the extra payments you can in that year without incurring any penalty costs, but keep your mortgage term as it is, because that will give you that little bit of extra flexibility if you need it in the future.
Yeah, the other thing we talked about in the webinar was, 12, 18 months ago, like a 1-year home loan rate was 7.5%. And if you just paid the minimum repayments on that over the term of the mortgage, you paid $1.2 million in interest. If you just keep, granted, 7.5% interest rate. I don't know about you, Makayla. I found them very painful.
I'm on a 5.79. I missed the sevens, thankfully.
Congratulations. It wasn't lucky sevens, that's for sure. But if you just kept your repayments at the 7.5% level in terms of what comes out of your bank account, when they're down to 4.7% where they are now, you go from paying $1.2 million in interest to $500,000 in interest. So you're $700,000 better off. And even if you can just make half the additional repayments, get a little bit higher, even before you start making extra repayments in that example, that extra 100 a week, you're still way better off. So something to think about.
Yeah, I think that's a good one. For myself, when I was going on to a higher rate, I thought there's no way I'll be able to afford this. I'm going to be destitute. Well, I've been paying it for a year without any issues, so I can obviously keep paying that without being in the hole.
Not
Maybe
destitute.
I will. All right, next up we have, what practice do you recommend when offsetting your mortgage with a flexible home loan account?
Yeah, So Mike and I did do an episode which was like how revolving credits will ruin your life. Got quite a bit of
Yes.
feedback on that.
That was a controversial one.
Even some of my financial advisors were like, "What you doing saying this? We tell people to use revolving credits." I think the same practice applies where if you're bad with money, it's not a good idea to have this money just pay off the debt so it's out of the way. Most people, so like just to recap what a offset facility is. So you've got a savings account and you've got a floating loan account. And like, I don't know, say if you've got $100,000 in savings and $100,000 in a loan, instead of getting paid interest, you don't pay interest on the mortgage. And the way banking works, hate to break it to you, is that they charge you more money to borrow than what you get paid to save the money. So you're better off by doing that. Some people do go, I think I can save $20,000 over the next 12 months. So they'll go, I have $80,000 in cash. I'm going to have a $100,000 loan. And my goal is like a gamify. I'm trying to save towards that amount. Fundamentally, though, how to set it up, talk to your mortgage broker, talk to your bank, and just do it. Just set off the savings and maybe think about whether you want to save towards a goal.
Yeah, I think if you have a big chunk of funds sitting in a savings account and you also have a mortgage, it's worth talking to your advisor or to your bank about setting that up because you can save some money.
Yeah, for sure. And then it effectively shortens the term of your loan, right? Because you're paying more principal, less interest.
Yeah, definitely. All right, next up. I have thoughts about this one. Do you think buying a house with a body corp is a good idea?
I'm guessing you're going to say yes, Makayla?
Yeah.
Love a body corp?
No, okay. I mean, if you're looking at an investment property or, you really want to live in an apartment or something, sometimes it's a bit hard to escape the body corp fee or the residence society fee. But they can also be quite hefty, especially if you're in a major city or you're in an older building. I have seen clients with apartments in Wellington with body corp fees of like 20 grand a year.
Do you know why that is,
very
Makayla?
Painful, like because everything's falling over.
Because everything is falling over. I got a client up here who's got an apartment with like 1.7 and they're paying $17,000 a year in body corp fees. And the crazy thing is, it still might not be enough money. That might pay for the lift and the landscaping and maybe the pool or whatever. But what happens if there's fundamentally, like with a lot of these Wellington buildings, something wrong?
Yeah. And I think that's the other thing that people don't think about when they think about the body corp is they go, oh, well, I can handle that annual fee. But you're also on the hook for if anything goes wrong with the building, everyone needs to pitch in to fix that issue. So if there's some kind of major problem, maybe your annual fee is only $5,000, but next year you might have to pay way more than that because there's something that needs to be fixed. So my thought is no.
Yeah. And also that means this apartments don't appreciate in value. Just go rent the sick apartment and when you quarter, don't buy it.
Rent vest. All right. This one we kind of addressed already. Should I prioritize investing in shares or focus on paying down my mortgage?
If you are a long-time listener of the podcast, you have heard me say this multiple times, but for the new people out there, firstly, welcome. Please subscribe to the channel, give us a review and a like. If you make like 10% on shares, you might go 10% is more than my 4.79% mortgage rate. But firstly, you have to take off fees. So we go from 10 to 9. Then we take off tax. We're at 6. Then we take off inflation because we're not spending the money now. We're down to a 3% net real return is what the cool kids say. And also the other risk, Makayla, is a lot of people go, well, mortgage rate's only 4.79. I would say a long-term average over 30 years of data is probably like 5.5% as an interest rate. So when interest rates keep coming down, it's going to get more and more attractive to invest into shares like we saw when like a mortgage rate was 1.99. But you got to remember, at some point, interest rates are going to come back up. And if you are paying more and more of that mortgage, when they do come back up, you're going to be in a better position.
All right, last section of questions. Before you can build wealth, you need to protect what you've already got. So we've got a few questions around this. First one, is it best to prioritize house deposit savings with a healthy KiwiSaver balance rather than putting money into managed funds?
If you're going to buy your first home, like it is a little bit potato because you can get your money out either way to be able to do those things. First thing I would say is it depends what you are like as a saver. So with my brother, who's done a podcast, we'll pop it somewhere around so you can have a look at that one. He was really bad with money, still is really bad with money. So I capped out his contributions at like 10% because it was forced savings. So if you're bad with money, the forced savings is great. putting a lot more money into KiwiSaver. I just don't like it because of the lack of flexibility. That what if you don't buy a house and you move overseas, or you want to buy an investment property and rent instead, then you can't do it. It just limits your options a little bit. And the other thing I would say on the KiwiSaver and the managed fund side is that if you are going to buy a house within 3 years, make sure you are just putting it in cash. You're not investing it into like a high growth fund or really any level of risk.
Yeah. We did have a client that put hers, not with us, in a high growth fund, and it didn't work out well.
Even happened with conservative funds as well a couple of years ago, because interest rates went up so quickly that bonds went down, and conservative funds have a lot of bonds, and the conservative funds dropped more than the growth funds.
Oh, interesting.
Yeah, it's a very unusual time.
Mm-hmm. All right. Speaking of funds, what is a good savings account? What type? What % of savings?
I don't know. I just feel like they're all pretty much the same, right? Like all the banks have roughly the same savings interest rates. There's no saver pies. They can be better. People like term deposits, but term deposits, like you don't have flexibility. They're locked up. What do you think?
I think if you're using just a basic savings account to put money aside, don't have it at your same bank you'd use for your everyday transactions. Put it somewhere where you don't look at it every day and you kind of forget it's there. And then when you need the money, it's a bit of a process for you to get to it, because I've always gone by that rule, and it just means I have to extra think about why I'm taking money out of it.
Does it stop you, or do you still just think about it and take the money?
No, it does stop me. Thank you.
Yeah.
Last question, James. As someone who doesn't own property but has $50K in KiwiSaver and $100K in savings, do I need a will?
Yes.
Yes.
It's 150 grand. Wouldn't you care who your 150 grand went to, Makayla?
Oh, yes, most definitely.
Yeah. So yeah, the whole will thing is really weird. Like 50% of people don't have a will. You should really have one, because people just assume how things will play out. But if you don't have a spouse, firstly, then that means that it could go to siblings or family members, or to the government is another thing that can happen. There's like a way it gets split up. Like Brady Bunch families can get messy. What if you got an ex-partner and they're still in the old will? Just tidy that stuff up.
Get a will. Jess and I did an episode about this, and we talked a lot about the horrors that can happen if you don't have a will. So, muy importante.
Okay, so there were the questions that we actually had way more that we had to skip over. If you want us to do another episode like this where we just kind of do some Q&A, pop the questions in the chat and we will answer them. We'll organize another episode. Makayla, thank you very much for joining me.
You're very welcome.
Now, Michael, if you are listening to this while you're in Greece, I just want you to know that this meant nothing to me. You are my one and only. Until next time, please give us a review, give us a like, and we'll catch you next time.
Bye.